Good evening, ladies and gentlemen. Welcome back to some major updates, not only on my stock portfolio as I answer some of your comments, questions. We're going to be taking a look at the broader markets over this week that have been rather destructive, to say the least. And first and foremost, happy Thanksgiving to everyone as we head into the Halloween season that ever so suits the current economic circumstance that so many of us are dreadfully living through as we talk about retirement, dividends, growth, ETFs, and so much more in between. So thanks so much for joining the Passive Income live stream at a 10 p.m. on a Sunday. For those of you that have less of a life than I do as well, we can get together and at least have a little bit of fun reminiscing about the markets. But let's get into this. But first and foremost, the portfolio updates, because I talked about this in my video, Selling BDY. I'm going to answer some of the questions because you guys are absolutely hilarious. But before we do, we're going to just take a look at the accounts, and then we'll take a look at the markets, some dividend and growth investor YouTube channels that I think are really interesting to just discuss because they're also very insightful. And then we'll kind of get into the Q&A side of this. But first and foremost, my corporate account. As mentioned, I did buy quite a little bit of the S&P this week, selling VDY, transferring a bit of money, looking more toward the growth vector, less toward the income-oriented side from a tax advantage standpoint. A lot of you have been offering me tax ideas and corporate accounts in Canada. It's very convoluted, but for now, I'm going to leave it up to the accountant, and I'm just going to try and core focus on capital gains over dividends, and the S&P, I think, can do that in a nice manner. We get a little bit of cash in US dollars, but not enough to be as concerned about the tax side of it. But taking a look at my personal account side of it, where I'm desperately waiting to basically start topping up my tax-free savings account, the largest position in my personal account still remains to be the Schwab US Dividend Equity ETF, which hasn't offered much outside of dividends from a return basis. But again, I bought it, literally toward the peak of the market. So if you look at the long-term gain in this account, I haven't really lost any money, whereas the market has been absolutely detrimental for most people during the time period I've been holding this over the last 2 years. So again, it's just been sitting here. It's been relatively flat. Just read. You can see that little D button toward the ETF kind of phrase there, which is just the drip is set up. This account is in my registered retirement savings plan. I'll never touch this. We'll leave it, and we'll talk about all of these a little bit more as we get into this video. And Andrew's saying that the stock market might feel like a trick right now, but the dividend yields are a definite treat. Yes, and we'll talk about that in a moment here. It's definitely intriguing. But taking a look at the broad markets, I think it's really intriguing when you look at it on a day to week to month to year level. And you can do that with these sector maps, which a lot of you guys seem to enjoy a lot, because in the last week, tech has absolutely exploded. And I think we're getting to a point where everyone is starting to hide out in tech. And I want to buy things like Google and Tesla and these companies, but again, it's just in this moment where I just don't trust the levels they trade at, where you can look at some of these dividend players and you see the value. Like, it makes sense to be buying them here. And I don't know if it's just people that are hiding out, looking for that return, if they think these companies are superior. I've noticed Google's really started implementing a lot of things, from trying to stop people from using ad blocker. All these companies are trying to squeeze out all that little bit of extra room of growth in this market environment that sucks. So you can see them just fighting to try and get that stuff kind of going. But as we zoom out into the 1 month, all of a sudden things look a little bit more negative across the board. As we zoom out into a 3-month performance, it's really intriguing to see Google's one of the only companies that really sticks out. Google Meta over the last 3 months, some of the best performers amongst maybe a couple of the healthcare companies like Eli Lilly. Go a little bit farther on the 6 month, then all of a sudden everything starts looking pretty good out of the consumer, more of the staple side of companies. And then let's just take a look at the 1 year. And this is where we can see a lot of the recovery that came into play in the S&P 500. But it's incredible to think you would have had to been buying a lot of these stocks pretty much within the about a year ago to be really taking advantage, because you've been buying them anywhere within the last 3 months or so. It's like you really haven't seen much of a gain out of this unless you were very fortunate to basically pick Google up on some of those dips. And then as we switch to the Canadian side of the border, things are obviously a bit different because Canada is bank focused and energy focused. So in the last 7 days, it's been one of the most abysmal markets the TSX has basically ever experienced in quite some time, as we hit new yearly lows. So if we zoom out on the 30-day, it starts looking even more abysmal. Like basically anything in the last 6 months, unless you bought some of the energy stocks like CNQ, which arguably are starting to pull back now because oil's starting to retrace here. And on the 1 year, it's kind of mixed, but the mega cap companies that hold up most of the, the TSX or some of these larger based ETFs that kind of represent the TSX aren't doing nearly as favorably. But you can see the mega caps that sit in here, like Enbridge down 14%, Royal Bank down 5% over the last year. Nothing incomparable to what the US markets look like. But a lot of this, I think, has happened just in the last 30 days. And I think a lot of this is represented by the Canadian drama that persists in the political landscape. I mean, Trudeau, I'm sure you guys have watched a lot of what goes on here in Canada, from the housing issues and the debt, and everybody in the US is talking about it. On a global scale, everyone's talking about it. Like, I've seen Kevin O'Leary kind of talking about it in the States recently. It just seems Canada can't get any kind of like substantial positivity in it, even though I live here. And I think Canada is probably one of the best places on the planet. We keep discussing this when it comes to healthcare. Till you hurt yourself, you don't really appreciate the benefits of living in Canada. I mean, there's so much like just diversity and food and culture, and there's a lot of great things about it, but that's not what people see these days. People just see pure negativity in an economy that's probably on the verge of collapse. I don't think that's the case. We'll talk about it more in a second, but a lot of what happens to Canada right now is going to basically be plagued by this. I mean, I think a lot of the banks are starting to oversell, but people are obviously concerned with continued loan loss provisions and oil continuing to sell off. And they're just kind of pre-pricing this into the future with another interest rate hike and longer rates, higher rates for longer. And that's going to continue to hinder a lot of these big companies that sit on the top of the TSX right now. That includes Enbridge, that includes the telecoms and all that. But yeah, if oil doesn't kind of, stabilize here, and it's kind of a two-edged problem, because oil coming down, if it stays at these lows and keeps coming a little bit lower, guess what? Inflation's going to look pretty good for the month of October, back to nominal inflation, perhaps. If mortgages and rental prices don't keep inflating on a month-over-month basis, maybe we're back to a nominal and end of the inflation cycle, folks. And if that continues, who knows? Maybe they won't leave interest rates higher for longer. Nobody knows. It's just a guessing game. You sold out of the Canadian banks at a wrong time. I own them and keep on buying RY, MFC, and BNS. Yeah, so I always like to kind of keep the perspective here. I'll come around to the portfolio side with some of the comments and questions, but especially around my portfolio. I sold out of the banks. I think a little, like when I bought them individually in my corporate account, that was a huge mistake because the corporate advisor, again, taxes and BS, they said, you don't want to do this. I thought VDY would be a better position for the shorter term into the end of the year. And then on Monday, I was like, you know what, I could just convert this now and then just, either start buying it within my regular brokerage account. Like today, I could literally just start buying it, but then again, I'll sell it at the end of the month and transfer it to my TFSA. So like a squirrel trying to find his nut, I'm not really sure if I should just be buying VDY now or if I should just wait till the end of the month and lump some into it. That's kind of like the squirrel in my head until I can start nominalizing every one of my accounts after this real estate purchase. But again, we'll kind of get into that in a little bit here because I don't know what's going to happen. I don't think anyone does. And to put that into perspective here, I think Joseph Carlson, we'll take a look at Joseph Carlson and PPC Ian. I think these two investors are on two very opposite spectrums of what they're interested in, and the insights they offer are very intriguing, I think. So I just wanted to break down like a 3-minute segment of this video because, man, this guy's got fortitude in a market like this that I haven't seen in a while.
Right now, we're trying to catch back up to the S&P 500.
Now,
if we look at this over time, I can show the graph here. This is what it looks like. This is the full story fund versus the S&P 500. And we have the story fund in blue, the S&P 500 in red. As you can see, when we started out here, it was tracking kind of in line with it. Then 2022 happened. We had interest rates going up. We had whatever happened with the economy. For some reason, investors were like, we want nothing to do with tech stocks anymore. So my portfolio plummeted. Now, that wasn't just tech stocks. I also made a couple really bad moves. I bought Netflix way too high, so that sold off big time. And then I also followed Charlie Munger into Alibaba, another big mistake. And I've promised myself I would never buy a company just because someone else notable bought it. And that's something I've kept to. The good moves that I did.
That's the hard thing when you're buying these big tech companies. There's always somebody notable buying them. And if you just stuck with the big tech companies, you probably would have did well. But when you're in the social media space, it's so hard to just kind of pick to an investment and not get caught in the, what's coming up sort of an idea. Because again, there's so much growth opportunity out there, and tech companies right now, I think, again, are extremely expensive. Like they're back to the values they were sitting at post crash. I mean, we're talking 30x multiples, but with none of the growth. Like we're all just presuming there's going to be growth at some point in the future. Whereas dividend companies and, consumer staples, their price multiples have dropped off a cliff, especially banks and these infrastructure companies. Yet nobody wants to touch them with a 10-foot pole. And arguably, if you are a value-oriented investor, which I don't claim to be, but if you are, I mean, you can't help but seeing there might be a higher rate of return somewhere in the near term than there will likely to be in these tech companies if you are a value-oriented investor.
That helped recover this portfolio was I realigned my strategy. I focused on companies that were only free cash flow positive, that had very solid fundamentals.
Sounds kind of like Jeremy.
I got out of stocks like Alibaba and ones that I knew less about. And instead of selling out of Netflix at the bottom, similar to what Bill Ackman did, he bought it and sold it 3 months later at a super low price. I bought more Netflix towards the very bottom when it was trading at a 16 forward PE. Netflix has gone up over.
I actually talked about Bill Ackman because he flipped into Google and made a great return. But as he mentioned, it's kind of ironic that if he just doubled down on Netflix, he would have actually came out of that pretty well.
Over 100% since then. And then I also bought more Google at a low. I own $32,000 of Google. That one recovered. So you can see this rapid recovery year to date. We've made a lot of ground, and this really helped us get back in the game. So we've gone through a roller coaster ride here, and I think the portfolio is in much better shape now. Right.
So again, much better shape this is what like the hardest thing for me is these days, because I've come down to like a core formula for investing to outperform, and everybody wants to pick like I used to, which again in the day was so much easier in a market where growth was so sustainable. But now it's just like you might as well, and this is again not financial advice, but I think if you want to outperform, it's easier to dump most of your money into an S&P 500, a VTI, a global market index, whatever you want, and then pick maybe 2 or 3 growth companies that you truly believe in, because your ability to pay attention to them is going to be far greater. Kind of reminds me of Warren Buffett's portfolio. Like just buy super foundational companies and then just overload on one company that has like real potential, like Apple, right? And that's worked exceptionally well for Warren Buffett. But imagine taking Warren Buffett's strategy and just buying the S&P 500 and doubling up, say, or taking an extra 10 or 20% into Apple, and how well you would have performed. I mean, I just feel like these portfolios today are even with tech companies, he's underperforming the S&P 500, and it's very, very hard to know exactly like what the market conditions are going to be at the end of this and what companies are going to have that technology that's going to propel. Because you look at things like Tesla, very speculative. And if that stuff works out, what does that say to companies like Meta, especially when Meta is putting all their money in, basically all their eggs in one basket when it really comes to the VR side of it? Does Apple have a space in there? Like, it's just hard to tell when you're not buying the full basket. So you got to be real careful, because you could pick 3 or 4 companies like Jeremy did and say only Tesla works out, right? It could be very detrimental. But let's take a listen really quickly to somebody like PPC Ian, because he's kind of playing more in favor to where I'd be more intrigued in the market at this moment. But again, we're going to round this off and talk about tech growth ETFs in a moment. But PPC offered some really interesting anecdotal information on his idea of the crash here.
Cycle that just keeps repeating itself. And the first stage of this cycle, as you can see in red, step 1 is a terrible situation will present itself. This terrible situation will generally seem to have no solution. At least that's how the media presents it. Right now, we're facing out of control inflation. Too much money was printed during the pandemic recovery. Prices are very high. Prices for consumers especially are very high. Input prices, though, for companies are high as well, but they're passing that inflation along to the consumer. And so because of all of this, because of the high inflation, interest rates are really high right now. The Federal Reserve has kept increasing the Fed funds rate. And this Fed funds rate has really permeated throughout society right now in terms of different types of interest rates being high. We're now seeing treasury rates really high, short-term and long-term rates. We're seeing mortgage rates really high right now. This is affecting home sales. This is affecting home buyers being able to go out and purchase a home. And so there's also other bad news right now as well. The government was almost faced with a shutdown. It was averted at the last possible minute, but we almost faced a government shutdown here in the US, and that would have been really terrible because the stock market would have probably fallen even more than it already has. But the stock market started correcting in anticipation of that. So we've got pillar 1 of this 4 kind of step process. It's always some terrible bad news, and usually there's no solution to that in sight. What happens next, as you can see on the screen, the second thing that happens in that process is the stock market crashes. It will maybe taper off a little bit like it is now, or it will even head into a full collapse. Now, we're seeing right now, even the core stocks are correcting. It's not only the ancillary stocks. It's not only the second-rate stocks. In fact, in my last video, I'll link to it in the pinned comment below, I already covered 3 stocks that have corrected quite a bit. And those 3 even that I covered, Raytheon Technologies, Realty Income, and General Mills, those are all core quality stocks.
So I want to talk about some of the core quality stocks. And as he mentioned too, I think it's important to move away from the big tech companies and where everyone's hiding out in cash, tech, and these very handful of investments, because I couldn't imagine what the S&P would look like just removing those when basically every company not every company, there are a lot of them are dropping, but a hell of a lot of them have dropped 30% or more. I mean, we're talking what I guess you could define as a crash from that aspect. It just didn't happen so dramatically. It's kind of been a slow roll as interest rates have taken effect into some of this. And let's kind of bleed into this because a lot of you guys have made some absolutely hilarious comments that I just want to highlight because they make me laugh, and I'm a bit of a clown here anyways, and everybody can kind of recognize that, I'm sure, at this point. But this guy, this is all in me relation to selling VDY. You know, I'm talking about buying the Canadian banks and buying the Canadian stocks, and then I go ahead and sell the Canadian stocks. This guy says it's just ridiculous, and you even mock YouTubers, and you guys have offered a lot of really intriguing advice here too. I think you need to make a plan and stick with it if you want to be an ETF investor. Bouncing your portfolio around will lead to trouble. I was guilty of it. I used to question what I was doing and make changes. Take the emotion out of it. Come up with a concrete plan, what you want your portfolio to look like. I decided I want my portfolio to be 65% USA, 17.5% Canada, and 17.5% international and developed. I then researched ETFs to give me this exposure and came up with 5: VFE, VGG, VCE, XEF, and TEC. I dropped international emerging markets XEC because governments in those countries aren't as stable. But India and Brazil, they could be powerhouses. I've come up with a plan and need to stick to it. In 20 years, it'll pay off. Cheers. Yeah, it's not like the worst advice by any metric. Chestad's awesome. He says, blasphemy, laugh out loud. I'm just reinvesting dividends, and I may hit a new dividend high if I keep this up in October. Congratulations, my man. Yeah, so this is, again, all in that idea that I'm like just kind of trying to figure my life out here. And I don't know exactly what I'm doing any more than you guys might. This is just the market cycles of me just trying to adjust everything between a multitude of accounts, multitude of income sources, from, you know, self-employed to salary, being employed, you know, trying to manage paying a condo down, which we, again, as mentioned, instead of investing a crap ton of money, we put another 30,000 toward the 15% we're allowed. We literally did that last week as well. So it's just a matter of like playing with this convoluted realm of what's going to put me in the best long-term position and taking the actions perhaps to just do it sooner rather than later. And then again, once we roll into next year, I promise you, I won't be as squirrely with my decisioning in the portfolio. And I didn't take a huge loss by any metric either. I mean, I think I had about a $20,000 position in VDY, and everyone's acting like it's my entire portfolio. And really it's like, I think 10% or less in the scope of it. And especially like with my fiance's portfolio, the real estate value, all this stuff, it's like maybe 5% or less at most, right? So it's not like I'm playing with this bar of soap to a major metric, because most of my money sat in the S&P and SCHD pretty much for the last since pretty much I think that area of 2022 when I started really selling off my individual core positions. And speaking of that, when we talk about these core positions, Chris says, I want to see your individual picks. It seems you're indecisive about making a solid plan on what you're going to do. After I bought my condo, I was and still is confused about what I'm going to do with ETFs and individual names. And as mentioned, I am in that position. I'm not claiming to be some iconic investor. I've done very fortunately well in comparable over the last year or two in the likes of Jeremy and the epic crash that destroyed a heck of a lot of YouTube channels that don't even exist anymore. I mean, I got out at a good time. I went broad index ETFs, and that's where I've kind of been stuck. I still really love a lot of stocks out there, but at the end of the day, there's such a large basket of them. I have a hard time defining what ones I just want to put my money in, because I don't like over diversifying. I could pick 10 or 20 names right now. I would have no problem buying, but then it just bothers me because what one do you keep buying? And are you better off just buying an ETF instead of paying commissions that we have to pay here in Canada? Because that adds up as well. And taking a look at stocks that I would have no problem, if you are an individual focused investor and you just want a core focused 10 or 20 stocks, I can name a bunch, not as financial advice, but as mentioned, something PPC Ian loves, which he's giving up on the broad-based ETFs right now to go back into the individual stocks because he thinks there's more value in the individual stocks than the broad-based ETFs. Again, Hershey here. I mean, I've been eating Hershey candy already because we're buying Halloween stuff. This thing has crashed. It's down 30% from May. It's just been in a cyclical continued down period, and I have not been able to put my finger on why. I feel like I'm missing some news or something's going on, because you don't have to look very far to see the growth this company's experienced. Now, their balance sheet is interesting. I mean, the debt to asset ratio isn't as appealing as I'd like, but the fact is this company is selling a conglomerate in the US and on a global scale in the candy industry. In fact, it's so conglomerated, monopolistic, that even Elon Musk called them out, right? And it stepped back, you know, all the way back to 2022 in value. And I mean, if this thing ever got up to 3%, even here at this value, I don't know. What do you guys think about Hershey? You look at all these consumer staples with things like Pepsi. I mean, Pepsi's a core favorite of mine, but it is top weighted in the SCHD ETF, I believe. But this thing is falling off a cliff too. I mean, it's down almost 20%. It's paying over 3%. Anytime this thing pays at 3%, it's usually a pretty good buying opportunity, which I always like kind of going back to macro trends and just zooming out on how many times in history these opportunities have presented themselves on a dividend standpoint. I mean, Pepsi here at 3%, which is not even recognizing almost there because it's over 3%. It did it back in 2021 once, and it hit about 3.3% in 2018. So to get a 3% yield, it's only happened twice, basically in the last 10, 15 years. You'd have to go all the way back to 2011. So there's only been 2 opportunities in the last 10 or 15 years to get this kind of yield off a company like Pepsi. Look at Procter & Gamble. I hope Procter & Gamble crashes more, because at the top of my list of end-all be-all stocks I'd love to own on an individual basis, Procter & Gamble has been one of those. And Procter & Gamble has never really offered that 3% yield. We'll pull it up just to see the last time it did. But I mean, we're talking about toilet paper. You're talking about like things consumers have to use no matter what. Now, there is risk with this. I've been talking with some investors about the long-term risk of companies that have stapled, it's the problem with things like Clorox and these companies that sell like one kind of specific brand, where people can just buy the off brand that's a lot cheaper, which comes as a concern. But I think Procter & Gamble has enough diversity in stapled businesses, but Amazon obviously trying to disrupt those businesses. So you'd have to really dig around, but I still think Procter & Gamble can't really go anywhere. But let's just take a look. It's a huge holding, I think, in a lot of big I don't know if Warren Buffett still holds it, but I know Ray Dalio holds it. A lot of major investors and celebrities have talked about this company. But let's just take a look and see the dividend history on macro trends, just to see how far back we'd have to get that 3% yield. I don't think it'll get there, but yeah, look at this. I mean, the last time you got a 3% yield apparently was in 2018, and it was up there for a little bit, I guess. 3.5% in 2018, and then it hovered around that 3% pretty much all the way back, if this is accurate. But I wonder if we can get back to those levels. That'd be super awesome. But at the end of the day, it's like, you could just buy SCHD, right? Or pick another, there's a lot of good dividend ETFs, DGRO. I've been looking at a ton of them, and that's the core hardest debate, right? Like, what are you guys doing? Are you picking up some of these dips? Are you more intrigued on the individual stock basis? Because to me, it's like, I find it easier to take my core positions in these ETFs and then just speculate on some of the small caps in crypto like I've been doing. Because I mean, like SCHD, as mentioned, I've been holding it since 2022 here. I'm only down about 5% from cost averaging. And yeah, it's been bleeding ever since, but I think this comes to an end at some point. Let's just see what the top holdings are, because the yield on this is getting nuts. I mean, the yield on it right now is 3.88%. We should look up the last time actually this paid out this kind of a yield. Let's just take a look at the holdings real quick, because right now it's what? Amgen, AbbVie, Chevron, Pfizer. A lot of the healthcare companies have been wrecked. Merck, Broadcom, Verizon, I actually like a little bit here, but again, telecom's getting wrecked. You got Pepsi in here, and most all these top holdings are equal weighted at almost 4%, give or take 0.5%. Texas Instrument, but let's just take a look. I'm kind of curious right now. SCHD, can we get the dividend history on macro? Because it's only been around for what? Just over 10 years, I think. Nah, macro trends doesn't even have a history on this one, I don't think. But if we take a look at the dividend history, I mean, the growth has just been stellar, right? The dividends have pulled back slightly, I think, since the readjustment they did, because obviously there was that readjustment, I think, a quarter or two ago. But even still, I'm skeptical on the dividend growth going forward in this economy until things start to nominalize. I think we'll get back to like exceptional dividend growth in a more, when people get greedy and interest rates start coming down again and the market can return to some form of normality. But we know the risk in dividend stocks is the fact that you're getting a higher yield today means there's risk that there might not be as much dividend growth into the future, right? What are you saying here? BAC is also a great valuation, in my opinion. Yes, I've been screaming the banks are probably one of the best buying opportunities right now. I'm more pertain to the Canadian banks, just because I think they're a little bit more. Again, if you don't think the real estate market's going to crash, because the real estate market crashes, I mean, that's the bet with the Canadian banks. I mean, I don't think it's going to crash personally. I think we could maybe see a mild correction in real estate, but the supply and demand, they're never going to fix it. There's no going back on where real estate is in Canada, just like New York, probably like San Francisco and LA. Like, it's just supply and demand. It's footwork, baby. It has nothing really to do with interest rates. It has nothing really to do with overvaluations and blah, blah, blah. A bubble happens. Sure, we're sitting in a bubble in the Canadian Toronto real estate market, but that bubble never drops if the footwork continues to move into this country the way it is. It's the same thing with New York. You could say like New York compared to Toronto is night and day difference. New York is way more expensive right now than Toronto is. but it's just footwork, baby. So let's just take a look here, because on the Canadian side of the border, as mentioned, like I said, there's two ETFs that I really love that I'll probably start buying within my tax-free savings account. And I'm really only looking at, if you're for income-oriented people, and this is what I'm looking at for like my parents' retirement. And again, the big risk with these right now is oil and what happens to these banks. But I don't think it's going to crash as bad as people think it's going to. I think a lot of that has been priced into this market already. Again, if oil comes down farther, we could see a further correction in the oil companies. But I mean, we're talking about an 18 to 20% drop. I could see this potentially dropping maybe another 10%. Who really knows? I can't tell you. I don't have a crystal ball, right? But I can tell you this is a great buying opportunity, because inevitably, if you can cost average in down here, it's going to come to an end. It's all based on interest rates right now. And people keep arguing with me that they'll never bring interest rates back down. They're going to bring them back down, folks, because people are naturally greedy. And we know that inflation wasn't caused by 0% interest rates or that 0.5% interest rate environment. It was caused by money printing. If we get inflation under control, there is no reason to leave interest rates up at a 5% level. They'll come back down to 4. And then people change politics and they're like, hey, we need more growth. Bring it down to 3. Oh, we could go even farther. Here, just bring it back down to 2%. And in that environment, we're going to see things shoot back up, because all that money that is getting sucked into these interest rates, like your telecom giants, they're going to bottom line that. That's going to hit their EPS, and boom, we're back into a new bull market where the recovery is going to be exponential, presuming there's no black swan event and presuming the real estate market doesn't crash. Obviously, you think mortgage rates will settle in the 3.5 to 4.5% range? See, I don't know. But I'm not betting on that. I'm betting on human nature and human psychology, which is over long periods of time, interest rates have always wanted to come as low as humanly possible. I think they could settle somewhere for a period of time, but again, that's all speculative in nature, right? I think if you come 3-5 years out, presuming there's no crazy economic event, black swan, war, geopolitical nuke being dropped, who the hell knows? I think in a normal market environment, we will go back to cyclically low interest rates. And I think it'll be much lower than people are anticipating, because that's what's killing the market right now. People just seem to think that we just need high interest rates for some reason, but we don't. We proved over the last decade we don't need high interest rates, and the market can function super efficiently. Because think about it, we're in high interest rates right now, and we're not in some economic crash. The whole market hasn't fallen apart. People have adjusted to these rates. People are still buying real estate out there. I mean, it's not like the market is in a bad place. So it's kind of like almost shocking, right? And I'm not a political guy, so I can't tell you. I'm just betting on human psychology. I agree with you. At some point, interest rates will come back down in time. Then money will come out of the CDs and put back into. That's just it. There's record levels of cash on the market. There's so much money sitting on the sidelines. It's almost unfathomable. A record amount that every month hits another record, because people are horrified. And unlike any crash in history, they're hiding in the US dollar on a global scale. Everyone's just flooding into US cash. As much as this geopolitical stuff is putting pressure on the US, if you haven't watched Putin speak recently, you should. Putin is a fascinating individual to listen to speak about the global markets. Comes from a very different perspective. But the fact is, with all the crap going on in China, with China trying to pull out, with the US trying to navigate its way out of the Chinese market, and all this stuff going on, everyone still wants US dollars. It hasn't hurt the US dollar at all. The US dollar remains insanely strong, right? So speaking at it from a tech perspective here, one of the biggest concerns that I still do have, and that's only in the macro, but again, I always recommend that if you love these tech companies, hey, buy the Qs, cost average into them. Hey, if you're going to buy them individually, make sure you don't lump sum and be done all at once, because I still think the valuations in these have kicked up. And as mentioned, if they do pull back, I have some capital on the side in my corporate account. I would love to buy these. It's just that I don't want to start flooding cash into these things, because I know that's where all the money is in this very moment. Everyone has been hiding in these companies, and if they start realizing these dividends are valued, you're not getting the same rates out of bonds and GICs, and they're going to want higher yields out of dividend stocks, and that's where the best bang for your buck is. Something tells me that's probably your best performance. And that's, like I stated, when the bottom half of the S&P that's trading at a multiple of like 15 right now starts to elevate the rest of the market, because again, wipe out the magnificent seven, and all of a sudden the market probably would be much, much lower than where it currently is. And that's my big concern with Tesla, right? Like, I'm looking at Tesla's probably one of the greatest companies I've ever seen in my life. I'd love to own this thing relentlessly, but it's just so hard to justify any of it right now when they're cutting costs. I mean, people just love this company, even though their margins are eating up. They're obviously fighting to deal with, like, everyone just presumes this company owns everything tomorrow, and we're going to price so much of that in right now. And I believe that to some extent. I just can't get over the fact that like car markets get wrecked in these kind of environments, and Tesla's fighting to just sustain themselves. And they're not fighting like GM or Ford. All those companies are losing money on their EVs. Again, another reason Tesla remains insanely valued, but they are losing margin in this kind of environment. And Elon is really pinning all of this on self-driving that doesn't exist today. So it kind of concerns me. But as I mentioned, when it comes to Tesla, I won't have any problem overpaying for a company if they're making money tomorrow off self-driving, even if it's $1. If they get one cab fare off a self-driven vehicle like Google has, I will just give them all my money at 100 times multiple. I do not give a crap at that point. But in this moment, I think there's just a lot of concerning volatility to continue, right? Is there any Canadian real estate ETFs that you would pair with VDY? Absolutely not. The biggest problem with real estate is most Canadians, and I talked about this with my mother, is when you buy a house, you're paying a huge premium for it. Like when I bought this condo, most of our assets today sit within the Canadian real estate market. Yes, I don't consider it an asset because it's not cash flowing, it's costing us money. But the fact of the matter is all of our, like the vast majority of our investments in Canadian real estate. Same with my parents, same with most Canadians. So Canadians, in my opinion, if you don't have like a $2 million portfolio and you're not, all your money's not in your house, it just doesn't make sense to buy more Canadian real estate because the market does correct dramatically, which it still is. I mean, Canadian REITs have been absolutely devastated. And I don't like them particularly outside of the, like, so a broad base, let me pull one up. I mean, what's the Vanguard Canadian real estate ETF? Let me just give you an example here. I don't like the real estate ETFs in Canada for any reason because they're too broadly diversified. And then the real estate market, you want to be highly focused on a particular few. I really believe that Canadian, REITs, US REITs in and of themselves are like diversified ETFs. Why is this not letting me agree? It's not, let me refresh this real quick. It's like broken. There we go. Can we get into this? Let me scroll down and just take a look at the holdings, because I'm going to show you what aspect of the real estate market I like. But again, in the short term, it makes sense. Long term, who knows? So if we take a look here right now, Canadian Apartment Properties is probably the best Canadian REIT you can possibly buy right now, in my opinion, if you're just looking for pure cash flow, very well managed, balance sheet, going to survive this no problem, and is benefiting from the higher interest rate environment. The fact that everybody's flooding into rentals because they can't afford to buy. Cap REIT is probably one of the end all be alls. You don't need to buy this diversified ETF. You could probably just buy that, cost average into it and be fine. But the fact is most of these are very risky. I do like RioCan. I still kind of like Smart Centers, but we actually still hold RioCan. My fiance holds a decent chunk in RioCan. I don't got an issue with these, but I wouldn't put like huge amounts of money into them. There's still like a lot of concern. I think RioCan is probably one of the best, well-rounded balance sheets coming out of the pandemic. They did a good job cutting the dividend, refixing the balance sheet. So they're going to ride through this. But where I'm really intrigued is in the industrial sector. Industrial has been just crushing it. I did a video where I talked about, if you go into, maybe I can pull it up quick if I can find it. If you take a look at the Toronto Real Estate Board stats, Toronto Real Estate Board statistics. I don't know if I can find this off the bat here, but if I can find the overview, yeah, right here. If you scroll all the way down, if you're buying REITs, this is what you really want to pay attention to. Because you don't want to be buying companies right now that have to rely on the transactional value of homes. Because if you take a look at the, where's the transaction? Total residential transactions are down 7.1%. Like the volume isn't there like it used to be. So where's the money in the Canadian real estate market? Well, we scroll all the way down. First and foremost, condominium rental stats are just flying. A one bedroom is up 11.6%. So you're going to find the REITs like Canadian Apartment Properties that is heavily leveraged primarily just in rentals. They're the ones that are going to continue to see quarter over quarter, year over year, as they replace tenants. They're going to get the benefit of this. They're going to crush because of this. They're never going to have to worry about interest rates because they're going to have a balancing act of interest rates going up. Sure, fine. But we also have monthly cash flow going up. So it's going to balance out a little bit. But where the real money is being made right now is in the commercial. And when it comes to commercial stats, you want to take a look at basically the industrial, because basically on the industrial lease rates, I don't know what's happening here, but they're up 48.9%. Take a look at that compared to the average lease rate on commercial, which is down 45%. So when you look at like commercial REITs, especially that's your RioCans, that's your Smart Centers, like they're not seeing the same kind of growth. Look at office REITs are only up 1.7%. Yet year over year, industrial rates are up 48.9%. You know how staggeringly insane that is? In one of the worst, real estate environments we've experienced in the last decade, somehow industrial is crushing it. So you want to look at some of the industrial REITs, right? Like Stag, Dream. I mean, just try and do some research on, like, are they growing? Why is there so much demand? Is it e-commerce related? Is, everyone just trying to look for places to store stuff for shipping? Who the hell really knows, right? You want to dig into that, but you want to look at the REITs that are benefiting. And Stag Industrial is trading down dramatically. So maybe do some research. You're getting a 30% discount, set $6 billion REIT, and look at their last quarterly earnings here from June. I mean, their stats are off the roof. Revenue was up 6%, net income was up 59%, EPS 61. So go figure out why. Do some research and maybe just hand select some sectors that are going to be sustainable for a longer period of time. So you can look at Canadian Apartment Properties, Stag, Dream Industrial. Some of those I think would be fabulous. I really went down a rant on that, but yeah, I do not like. I just do not like, any of these broad-based ETFs because they just underperform so badly. You're not going to like this, but you're not going to like it. But here's what I do. Step 1, put almost everything into Altria and Enbridge. Step 2, pray to God there's no dividend cuts. And hope it's worked out so far. And Rochester said, step 3, stop gambling. With my parents heading into retirement, with talking about retirement, it's so hard to fixate on some of these individual stocks, but we're looking at things like BTI. Enbridge will get out of the ETFs. I would never buy them individually, but we will probably hand select some more speculative companies. And honestly, I'm looking at things like BTI over, say, Altria Group. I really like BTI right now. You'll never get capital growth out of this company, but I think there's some favorable values here to lock in a 9.3% yield. We're looking at things like MCAM Mortgage Group, any of these mortgage companies that aren't in the same position to have to put loan loss provisions aside like the banks are. These mortgage companies have been second, third-party lenders. They take your money. You can even give them your money as a business and they'll loan it out. And obviously you want to try and get first mortgages, or at least try and get, I'd have to dig down to see exactly what kind of mortgages they're offering. But these third-party lenders have been crushing it. Because the markets remain so strong. And, it's just that obviously, AAA rated mortgages have fallen off a cliff and that puts the bank at risk. So they have to put loan loss provisions aside. But MCAM Mortgage is already used to putting riskier mortgages into the market. And it's been working out very favorably for them because apparently the market conditions weren't as bad as people thought. And people aren't defaulting across the board. And this thing trades at a 6 times multiple right now. And it's got a 9.9% yield. And they've actually increased the yield over time. And they've had a very long history going back all the way to 1995. So I got to applaud the MCAM Mortgage Group for, just being an astounding dividend stock in Canada here that nobody understands or has really talked about because it only trades for $538 million. It's a pretty small cap company, right? I still want to wait for the US dollar to dip to transfer my CAD. 137 at this time is a big loss to gain. Let me reread that. At this time, it is a big loss to my gains. If I can get it at $1.35 or $1.34, like it was just a week ago or so. So when it comes to me transferring money, because obviously when I sold VDY, I transferred it to US dollars. I bought some VOO, I put a lot of it into VOO, kept some cash. The problem is I don't like speculating on currency conversions because it's a very risky game. And I'll give you an exact example. So if we go back over the last 5 days here, which it doesn't go back because we're into the weekend here, but I did it on Monday where I transferred that money over to USD. I didn't care what the value was because we can see there's been some volatility here where we've seen the value of the US dollar go down and then back up. And the problem is if you thought if you wanted to wait for a better deal, and let's say you get another 0.5% or a percentage point. Okay, well, while you've been waiting, what happened to the US investment you wanted to make? Well, if we take a look at the last 5 days, well, we can see if I bought it on Monday here, where's Monday? So probably right around Monday, I put some in, and then somewhere over here, I put some in. I mean, the stock jumped up, 1.3% from Monday? So, you take a look at that big jump, which I did Monday morning, and, is it really worth trying to squeeze 1% or 2% out of the currency when there's so much volatility in the markets? I mean, obviously nobody knows, but I'm not speculating on it. I don't care if the dollar's up or down. I just do it. And that's the same with buying VFE, right? Like if you don't even convert the currency and you just buy VFE, you're already paying the currency conversion difference anyways. It's just, you don't have to convert the dollar. This, index does it for you. So I don't play the currency game. I think it's going to lead to some trouble. But nonetheless, you did what? I bought VDY in the high 30s, but see your point about investing in the US. Again, I'm not adverse to just investing in the US, but over the history of my investing channel, as many of you know, most of my money has always been in the US markets. I'd have to go back and look at the early day videos that I made, but I've always been a huge avid investor to the US because that's where most of my returns have come from. And as a lot of big investors that I watch here in Canada, they always say, hey, look, spend Canadian dollars, but make US dollars. Because at the end of the day, you've always wanted to be in the US markets. I think if you're looking for cash flow, you want to be in Canada, but I'm a younger investor. I'm not fully dividend oriented. So obviously I'm going to be more inclined to want to look toward US stocks. But there is no indication of an economic downturn, question mark, exclamation mark, question mark. So in this video, I said, look, like, I don't think we're heading into a substantial crash by any metric. I don't think we're heading into a market environment that was as bad as the 2008 or the dot-com bubble. So do I think there's an economic downturn? Yes. We're going to see probably a mild recession. That's my guess. I'm speculating. I'm a clown. Don't listen to what I'm saying. I just, in my opinion, don't think we're going to see an economic crash. And if people think we are and they price stocks as though we're seeing a crash, then buy them. Because there's just no data here that really supports something that is as catastrophic, I think, as 2008. It's just my opinion. You can speculate and go buy gold. Hey, if you want to be a gold bug, do that instead and tell me how that works out, because it hasn't worked out that great so far, right? Kyle, are you still buying VDY as it's going to get hammered with energy, oil falling, and all the financial stocks in this ETF? Do you see it going below 32 by the end of October? If I had my access to my TFSA, I wouldn't care. I'd be buying it right now, cost averaging every single month. I might do that in a regular brokerage account, as mentioned at the beginning of the stream. I don't know how low it goes. Damn it. I just like the value of it here, and I'd be buying it here, especially if I was heading into retirement. I think now is a great place to start. Just don't do it all at once and patiently take 6 to 12 months, buy into it in this higher interest rate environment, because inevitably when interest rates, people speculate they're going to be cut. Guess what? All these stocks are going back up long before they cut interest rates, because people like to price that shit into the future. But yeah, I'll be buying it back. Don't you worry. In less than 3 months, I'll be buying it. Calm your horses, people. I'm not your Meet Kevins of the world. I'm not liquidating my whole portfolio to pivot into starting my own ETFs and forcing you to buy my real estate funds. I'm doing the same crap I usually do. I just get a little squirrely sometimes and I move a couple stocks around. To my detriment, who knows? You'll have to subscribe to find out, because I'm not the all end all be all of investors here. So sometimes I'll make mistakes, and I'll gladly publicly share that with you here. But let's get into a couple quick questions. You host videos for Victory Square Technologies on occasion. What do you think of them? It's kind of, I'll have to double check Victory Square Holdings. Is that, what is that? Victory Square Holdings? I have no idea what that, are you talking about what are you talking about? Not Victory Square Technologies. I'm very confused about this stock. Maybe it was one of the sponsored videos. Some of you guys have discovered my job because I work for independent companies and I do the interviews for a ton of publicly traded companies. And some of you have caught on to that and have been seeing my face pop up elsewhere. The ticker's VST. Let me just pull this up real quick and we'll take a look. You guys have any other stocks? Let me know now before we finish up. It's called VST, Vistra Corp. Is this one that I actually work for? Vistra Corp, are you sure? What am I doing with this one? You host videos. I'm gonna have to double check that one because I'm having a hard time finding it. It's an ETF. Vistra Corp. What is this, man? Financials, holders. I'm gonna have to take a look, my man. I don't even know what this is, so maybe I'm just missing something. For growth, would you suggest XEI or over VDY or XIU? Let me just take a quick look here. XIU stock. XIU is the iShares S&P TSX 60. Honestly, it depends on what you want. I do like the broader index VCE over XIU, for example. I do like Vanguard because they've actually outperformed this ETF, I believe. But if you take a look, I mean, these are just broad Canadian ETFs, right? They're just diversified, the top weighted. So you're just getting like the S&P 500 version. XIU and VDY or VCE are both great ETFs. It's just a matter of what you want specifically. And I found that VDY has actually outperformed VCE and XIU over the longer period of time because Canada is primarily a dividend-oriented country. So if you're collecting dividends and reinvesting them, you tend to see a bit of a higher rate of return. But nonetheless, and because it higher weights, so for example, XIU only has 7% weighting in Royal Bank, whereas Royal Bank and these top weighted banks have been the best performers in Canada, pretty much next to CNR and some of the railways. But from a dividend increase standpoint and just from growth, the banks have done an exceptional job. So if you held VDY, you've seen that performance. But honestly, if you want a little less risk, a little more diversity, you want some exposure to CNR and some of the growth companies, yeah, I mean, by all means, just buy VCE or XIU. I think you couldn't go wrong. Pair XIU with the S&P 500, you're doing great. Where are the holdings in here? Why can't I find them? Am I blind? Financials. Why is it not showing me the holdings? It's like, oh, there they are right there, right? No? No, am I blind? Forget it. I'm going to move on. You guys know what's on VDY anyways. For some reason, it's not loading. Do you still think AMT is a good buy consideration? Is that Alimentation Couche-Tard? Is that what AMT is? I don't like it. I've never bought it. Or no, American Towers. God, I'm an idiot. Sorry, folks. Let's got to pay a little more attention here before I start zoning out at the end of this stream. American Towers is probably one of the most fascinating U.S. REITs next to, I think it's Crown Castle. American Towers, man, these are REITs that primarily rent to telecom, infrastructure. Canadian REITs do this as well. If you look at RioCan centers, sometimes you'll see one of those big telecom towers. In fact, my condo right across from us is a telecom tower in the mall. That's what a lot of these malls do. A lot of big condo buildings make extra income by renting out the top of the building and putting telecom communications up. American Towers is super intriguing here. Same with Crown Castle. I know Fast Graphs. Go watch their videos. Fast Graphs did a really good job analyzing these. But yeah, these are probably some of my favorite REITs in the U.S., actually, all things considered. They've been some of the best performers, and nobody really talks about them, and they're trading at very favorable multiples right now, in my opinion. Probably take a look at Crown Castle, maybe over American Towers, but, give or take, they're two incredible REITs, to say the least. Can you check out Well Health? Yes, I actually worked with this company once upon a time. Well Health, if you're into the growth vector of things, this is probably, there's companies I've been talking to that are spinoffs of industries that work for Well Health. I'd have to do a bit more digging as of recent to see where they currently sit, but this is kind of like one of those Canadian healthcare growth stocks. I think it's similar to what's the telehealth company in the US that was a Teladoc or whatever. It's probably like the Canadian counterpart growth version. This is an intriguing one to think about. I mean, their growth is still pretty exceptional here. I just have to dig a little bit deeper. I haven't looked at it as of recent. Thoughts on EIT.UN? Yeah, are these some of those EIT? Is that what's I think I know this one, EIT. I think this is that Canoe fund, isn't it? Yeah, the Canoe EIT. These are kind of I'd have to look into this one. I know my buddy used to own it. It's actually been performing pretty well. It's been a bit stable here. I mean, it's only down 5%, right? Again, I wish I had an answer. I'd have to dig a little bit deeper. But Joseph Carlson has way too much tech. I don't think people realize tech stocks are cyclical. Yeah, that's my concern, right? I'd love to buy tech here. It's hard to trust when everybody's, believing in it so heavily and not believing in the rest of the market. Yeah, EIT has been pretty great. Let's just pull it up quick and we'll take a look at the fund itself, because it is one of these dividend focused ones, right? I'm curious to what the yield is on this. Can we just take a look at the growth? So say you invested $10,000. I don't know what's wrong with my internet. It just doesn't want to load. Can we at least see the holdings? Can you show me the top 25 here? Philip Morris, Restaurant Brands, United Health. Is this company's usually writing covered calls against this, isn't it? Let me just take a look here. Top 25 makes them 71% of the fund. Canadian Pacific Kansas got the railways in here. It's got Royal Bank, Toronto Dominion. It even has Berkshire Hathaway. Very interesting. Can I see the fund statistics on here about the fund? I just want to see what the data is. Fund highlights. Can I see that? Investment approach. What do you guys know about this? Fund profile. Annual compound growth. Can I just see the dividends, the returns? Why is it all not loading? God dang, I really hate my internet here. What the heck's going on with it? Anyways, I'll take a look at Canoe. You guys seem to like it a lot, so maybe I'll do a specific video on it. It'd be fun to break this down and figure out what the exact details are on it. I'll leave some comments down below too. Give me some insight on it, and I'll definitely dig a little bit deeper. Close to retirement. I'm majority SHD, even with the recent dips in J&J, Pepsi, Procter & Gamble, McDonald's, etc., are just now close to 3%, but Geigars are all single digits, whereas SHD is 13+%. Yeah, like I said, J&J has never been that much of a grower. I like Pepsi, Procter & Gamble, McDonald's for sure. But again, don't trust SCHD because the 13% Geigar is probably going to change because they're very heavily invested in a lot of healthcare. I don't know. It's hard to tell that Geigar is trustworthy because you have to go back, during a time that was much better than it is now. Also, have you seen YouTube channels, Heresy Financials? He's got a great way to explain the markets. His videos don't fall for the suckers rally is very interesting. I'll take a look after the stream. After looking at almost Vanguard BlackRock funds, I've come across these solid ETFs with Canadian home bias. And you're talking about XAW, SHD, VDY, SHY. Thanks for recommending me. It's something we can all kind of just dig into by the end of the stream or just something to do over the weekend. But I will probably take a breath here, folks. We've been 50 straight minutes of fun. I always appreciate you guys coming around for this haunted, crazy market experience that we're all just trying to survive through and come out on the other side. But so long as you're damn well buying. At the end of the day, I don't care what you're buying. I don't care if you're buying overvalued tech. I don't care if you're buying deep discounted things like Hershey's. Damn it, just so long as you're buying. That's at the end of the day what works. Just don't put all your money in one thing and just keep buying. It's so crazy how like philosophically that works out over a long period of time. I mean, imagine buying Apple at the peaks in the dot-com bubble and you still kept buying it, where you'd be today. I mean, imagine just buying crap and never selling it because I'm just so damn schizo. I did a video and it's so funny because I don't like saying, you know, if you're young enough, you can buy companies at all-time highs. You don't have to worry about it in your 20s. But even if you go back to 2000 and you look at the top-rated companies in the S&P 500, things like Walmart and GE, and if you even picked 5 of those and you go back and look at the performance, 2 or 3 of them, if you ended up picking Walmart or some of these other companies, you would have done so well, even though GE didn't do that well. And GE is still around, right? And you still would have collected dividends and you still would have been diversifying and buying other stocks probably, or ETFs or whatever. I mean, at the end of the day, just keep buying. Don't stop buying. You'll come out on the other side of this. I promise you'll do fine. The only people that lose out are the people that aren't buying. I promise you that. Come back to me in a year or two. We'll see if my predictions are right. We'll see where interest rates go. But hey, I'm just doing what I'm doing. Stay cool. Stay awesome, folks. And as always, I look forward to catching you in the next one. Peace.